December 2022, question number 3. So this is advanced financial reporting. Although the question can really be very good for students who are also doing financial reporting, the intermediate one. Very good question. 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 Now, ladies and gentlemen, we are told here, question number 3, December 2022, that H Limited, a public limited entity, operates in the information technology sector. It has made several investments in other companies within the industry, which has earned it market leadership in the sector. The following draft financial statements for the year ended 31st October 2022 relates to H Limited and its investment companies. So we have there statement of profit or loss and other comprehensive incomes for H, S, and L. And then we have here statement of financial position for the 3 companies again. So remember the date of the financial statements there is 31st October 2022. So then we start reading the question for us to be able to get the group structure. So you're told additional information, H Limited acquired an 80% ordinary shareholding in S Limited on 1st November 2019, when the retained earnings of S Limited stood at 340 million. The acquisition consideration comprised cash of 1830, the fair value of the identifiable net assets of S Limited acquisition date were 2440. The excess of the fair values over the carrying values was due to an unrecognized brand whose remaining economic useful life at the date of acquisition was 5 years. So first of all, we start with the group structure. So the group structure like that. So this group structure, we have a H, which acquired 80% of S. 80% is so huge, it's more than 50%, meaning that S is a subsidiary. So I'll be interested in knowing the date of acquisition. So the date of acquisition, you're told, it was acquired on 1st November 2019. So 1st November 2019. That is the date of acquisition. And then we have in this case here the date of the financial statements. Date of the financial statements. I can see financial statements given, and they are dated 31st October 2022. 31st October 2022. So here we can only talk about number of years. It cannot be number of months. Right? So the year ending 2020 becomes first year. 2021, second year. And you can see we are going to 2022. So basically number of years here, you guys must have gotten how many years? 3 years. 3 years. From the date of acquisition to the date of the financial statements, we have 3 years. We have 3 years. We have 3 years. So is that, first of all, understandable? Is that okay? Is this okay? 3 years, yes. Now we continue. I'm looking for another company, information for another company called L Limited. L Limited. So I'm told you that M Limited is the main competitor of H Limited. And on 1st May 2022, M Limited and H Limited each acquired 50% of the 200 ordinary shares in L Limited. So in this case here, H went ahead and acquired 50% of L. So meaning that automatically, I should be able to account for L under IAS 28. Under IAS 28. So this L ideally should be a joint venture. Joint venture, if you remember very well, joint ventures and associates, we shall always use IAS what year? 28, what we call the equity method. equity method. So don't consolidate L. Don't consolidate L at all, because in this case, it's a joint what year? It's a joint venture. And under joint venture, we shall do, under IAS 28, we shall do just one working for the joint venture, where we look at the cost of the joint venture, add any profits post-acquisition, less any impairment. We don't consolidate. The same case with associate. However, in this sitting, this examiner was a very, very bright examiner. He really messed my students big time. Those students, of course, who don't do their homeworks like that. So they were really, really confused, and they got zero. They got zero in the entire question. All right. Now, ladies and gentlemen, in this case here, what have they told us regarding this question, which made students who are bright, students who are doing their homework, which made them, in this case here, consolidate? They went ahead there and told us, yeah, the consideration paid by H Limited consisted of cash of shillings 15 per share, and also a 1-for-2 share exchange when the market price of H Limited share was 20. M Limited also paid 15 per share for their interest, but did not issue any shares to the owners of L Limited. The ordinary shares of L Limited have 1 voting right each. Upon the acquisition, H Limited had a contractual right to appoint 60% of the board of L Limited, with the remaining 40% appointed by M. It's called substance over form. Substance over form. Yes, we have Mr. 50%. You know, when you have exactly 50% of a company, that company will be called a JV to you. That company will be called a joint venture. That, in this case here, is the form, a joint venture. But remember, we said that control is no longer being looked in terms of the shareholding alone. We look at what we call substance over form. That fine, we have 50% of this company. It should have been accounted for as a joint venture, but you have contractually been given the right to appoint more directors, to appoint many directors. How are these companies ran outside here? They are ran by board of directors. So the person who has got powers to appoint more directors, many directors into a board, even if he has 20% of the company, even if he has 5% of the company, the moment we sit down and agree that this person who has 10% of the shares is the one who is going to run the company, is the one who is going to manage the company, then that company becomes what here? A subsidiary. So in that case here, L is a subsidiary as well. L is a subsidiary as well, by virtue of the fact that H has been given a mandate to run L by appointing 60%. 60% is quite high. It shows control by appointing 60% of the directors. So in this case here, L, by virtue of us being in control, management-wise, L becomes a subsidiary, and therefore it has to be consolidated. It has to be consolidated. Anybody who left L out of this consolidation equation got a zero in the entire question. Got a zero in the entire question. So in this case here, L has to be consolidated by virtue that we are controlling it through management. Through management, we have a bigger share of what here? We have a bigger share of management. That concept of management control is key. If you look at your past papers, there is a semester they gave us a company which had acquired just 15% of another company A. But this company with these 15% shares, they were given a contract by the other shareholders that you guys, you have the time. Yes, we know you only have 15%, but because you have the time and the expertise, we want you to be running this hospital. We want you to be running this hospital. By virtue that now they're the ones who are managing the hospital, their shares of 15% notwithstanding, automatically they're the ones in this case who wield the control. You don't need any shareholding, all right? You don't need any shareholding in this case here to have what we call control. Even in government, I can tell you, there are guys in this case who don't have any shares in government, but they have lots of what here, they're controlling their government here. All right. However, as we shall also be seeing later on, in terms of control, you can't be having exactly zero, and then you say that now you have a contract to run the company. And because you have a contract to run the company, then you say that you have control. No, no. We shall be using a principle we call pair to be able to ascertain this principle, to be able to ascertain in this case here, this control aspect, we shall be using in this case here what we call the pair principle. I'll come back to this later. Pair principle. So under pair principle, you must be powerful. There must be power. You must be having really powers to run the company. All right. And then in this case here, we must be having what we call exposure to variable returns, exposure to profits. So exposure to profits, you must be having some shares, however small. You must be having some shares. You must be having some shares. Pair principle. So you must be powerful in the company and you must be having some shares. And then lastly, you must now be able to use your ability. So we have ability to use your power to increase your returns. This is how we define control. So you could be having in this case here, like what here, just 10% shares in a, so long as you have got some shareholding, and then you happen to be very, very powerful, right? Then of course, because of the ordinary shares that you have, you are exposed to the profits. So you can't joke around. All right. So you'll be using your power in this case here to increase profits, because you know that if you increase profits, what will happen in this case here to your returns? It will increase. And then you must be using that power to increase your profits through what we call ability. So later on, we are saying that fine, even if it's in the government and you happen to be having like 0 shares, even if you wield lots of power, even if you wield lots of control, then you can't take the government to be your subsidiary. No, no, no. But in this case, ladies and gentlemen, we happen to be having some exposure. We have some shares here, 50%. And now we are being given the company to run. Because once you tell me that I'm the one who is able to appoint 60% of the directors of L, that is as good as running the show. Because I mean, how are decisions in a company made? Decisions in a company are made through directorship. It's called force versus arbitral. The majority of these directors will always carry their day. So when, for example, a particular decision is to be made, they're told to raise their hands. If there are 10 directors, if 6 say we want this, then the company must move in that direction. So whenever you hear of this concept of management being given to a person, always think about what here, control being passed to them. Control being passed to them. So then L, he's a subsidiary in that context, not a joint venture. So I would want to know the date of acquisition. The date when we acquired this L. We are told here we acquired L on 1st May 2022. 1st May 2022 like that. 1st May 2022 like that. That's the date of acquisition. 1st May 2022. And when are we doing these financial statements? The date of the financial statements, ladies and gentlemen, we are told here is 31st October 2022. So are you able to count here? We can only talk of number of months. Is there somebody who is able, so I can see the whole of May? Whole of May, we have June, July, August, September, and then the whole of October, because you're going to the end of October. So these are 6 months. These are 6 months. Great. So our subsidiary for 6 months. Subsidiary for 6 months. Thank you so much. So if I'm the one, if I'm used to this shortcut of doing the pro forma, which I've told you in those videos in the LMS, I can go ahead and do the pro forma. But now because we have the time here, if I'm the one, ladies and gentlemen, doing this question, after I do group structure, I would want to understand the net assets of my subsidiaries. I would want to understand the net assets of my subsidiaries. So we start with net assets of subsidiary S. Net assets of subsidiary S. I mean, I can't acquire subsidiaries here without knowing the valuation. So now I'm doing valuation. So in this case, ladies and gentlemen, I will come and stock of net assets of subsidiary S at acquisition, and then we have here at what year? At reporting. At acquisition and at reporting. And they were the guys who told me that Mwalimu, for valuation of net assets, we shall be looking at equity. If you remember, we shall be looking at equity. You guys, do you remember the components of equity? Are you able to remember the components of equity? Is there anybody who is able to remember the components of equity here? Components of equity. Because net assets equals equity. And the components of equity, what things do we look at to be our equity? We have share capital. Yeah, we have ordinary share capital. We have, in this case here, share premium. Share premium. We have what we call fair value adjustments. We have retained earnings. We have fair value adjustments. Then, of course, I will have here depreciation of fair value adjustments. Depreciation of fair value adjustments. Now, apart from this, is there any other thing you guys should always think about whenever we talk about equity? Any other thing apart from this that we should always, that somehow we should be able to think about? Apart from these usual ones. Yeah, the UPS, whenever the transaction is upstream. Thank you very much, Laura. UPS, whenever the transaction is upstream. Upstream means subsidiary selling to parent. Subsidiary selling to parent. You know, we have the parent here, parent company, and then we have, in this case here, the sub. When the parent sells to the subsidiary, that's normal. That's normal because parent is bigger, I mean. But when these things struggles a lot to sell to the parent, the subsidiary sells to the parent, that's called upstream. And if it's upstream, then it must always appear in the equity of the subsidiary. Because remember, here we're looking at net assets of the subsidiary. So UPS is unrealized profits on stock. But you only bring this UPS here whenever we have what we are calling upstream, when the subsidiary sells to the parent. So let's populate this. Remember, we are looking at subsidiary S. So go to subsidiary S, statement of financial position, subsidiary S. Is there somebody who is able to see their, share capital, subsidiary S, in the statement of financial position? Is there anybody who is able to see their share capital? 1,500. So then we have ordinary share capital here, 1,500. This never dances. This never changes. For the subsidiaries, they never change. Share premium. Are you able to see the share premium, ladies and gentlemen, for this subsidiary S? Remember, I'm not talking of L, I'm talking of S. So in this case here, the share premium, 500. Never changes. 500 never changes. 500. Then we go to retained earnings. Retained earnings. What I'm able to see in the statement of financial position, retained earnings there will be in this case here, this 2090, retained earnings 2090 here. That is at reporting. Because this at reporting is at the date of the financial statements. For retained earnings, normally your examiner would give you retained earnings at acquisition, or he would need you to calculate retained earnings on the date of acquisition. Has this retained earnings been given to me? 2070, it's given in note number 1. It's given in note number 1, where they told me in note number 1, yeah, H limited, or 2070. Where did I get 2090 from? Where did I get 2090 from? So we have retained earnings. We have here 2070. I took the one of L. So thank you very much for the correction. 2017. How about retained earnings at acquisition? You'll be able to see here in note number 1, H Limited acquired an 80% ordinary shareholding in S Limited on 1st November 2019, when the retained earnings of S Limited stood at 340. So retained earnings at acquisition is 340 like that. It's 340 like that. Now, ladies and gentlemen, is there a place where they are telling us that S and F did business? Is there a place where S and H did business? If you look at note number 4, we are told during the year ended 31st October 2022, S Limited sold goods worth 400 to H. So I can see this is what year? This is an upward transaction. It's an upstream subsidiary to the holding company, to H. Yeah. And in this case here, we are told that it reported a gross profit margin of 25% on all of its sales. 20% of these goods remained in the closing inventory of H Limited. So then if they did business, and especially if it is the subsidiary that sold to the parent company, if it's an upstream, then I have to compute that UPS. I just have to come here and write here UPS by the side. UPS by the side. I must need this working where we have the UPS by the side. Where we have UPS by the side. So I'm calculating this UPS because it is upstream. It's upstream. So upstream is not a big term. It is the subsidiary that sold to parent. So UPS will be equal to profit margin times remaining intra-sales. 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 So have they given me, in this case here, the profit margin? Oh, yes. They have told me in note number 4, the gross profit margin is 25%. The goods sold in between, they told us they were worth 400. The inter-sales was 400. But out of this 400, I'm only interested in the remaining. I'm only interested in the remaining intra-sales. I'm only interested in the remaining intra-sales. So the remaining intra-sales, ladies and gentlemen, the remaining intra-sales here, they've told us 20% of these goods remained in the closing stock. So 20% is what here remaining intra-sales. So then are you able to give me this UPS? Are you able to give me this UPS? Are you able to give me this UPS? So Igamba, she's telling me that in this case here, UPS is what here? Is 20. All of us, I don't know whether we are able to get this. You take 0.25 times 400 times 0.2. Caroline, 20. And then Caroline, I would really request, if you know how to rename yourself, Caroline, I would request you go and start your name with capital C. With capital C. Caro is a big name. It's a big name. So if you know how to rename yourself, you can start with capital C, your name. If you don't know, no worries. But next time, is all the students in this case should enter classes using capital, not like capital letters, but I mean, you should start your name with a capital letter. And if possible, because you're passing, you need to start calling yourself just here in Zoom. You can call yourself, in this case, your CPA Igamba. Yeah, because you're passing. That's how you start owning these things. Here in Zoom alone, not outside there. Here in Zoom alone. So then this UPS, ladies and gentlemen, I'll be able to take this UPS straight away here at reporting. So UPS, we have here UPS at reporting here, 20, not here. Because they never did business they did business over the period of post-acquisition. And that has to be deducted because basically that's a fake net asset. That's a fake net asset. How do you claim to have made profits in this case here from your sister company? That's a fake net asset. So that has to be deducted. All right. Now, ladies and gentlemen, let's now read this question very well. Roman 1. We are told H Limited acquired an 80% ordinary shareholding in S Limited on 1st November 2019. When the retained earnings of S Limited stood at 340, the acquisition consideration comprised of 1830 million. The fair values of the identifiable net assets of S Limited at acquisition date were 20 2440. So you see the total net assets at acquisition date were 2440. The total net assets at acquisition date were 2440. 2440. And then they are telling us that the excess of the fair values over the carrying values were due to unrecognized brand whose remaining economic useful life is 5 years. So, ladies and gentlemen, then we are saying that should we add this and then get a different figure? The excess will be due to a revaluation here. And how do we get this fair value adjustment? You will come and take 2440 minus 340 minus 500 minus 1500. So you take, normally depreciation of fair value adjustment at acquisition, it's not there. We can't get, at acquisition, this asset is new. So the only balancing figure that we have here will be this revaluation. This revaluation. How do I get it? I will take 2440 minus all the others for the entire thing to balance. So Mauritia, she's telling me that this fair value is 100, like that. And remember, whenever you get revaluation, fair value adjustment, you must book it both at acquisition and at reporting. So this fair value acquisition, when I get it, I'll have to book it in both places, like that. And then I'll remember that this was a forgotten figure. So it has not been depreciated for all that time. So then you need to come and give us the depreciation of this fair value adjustment. So how do you give us this depreciation of the fair value adjustment? To get this depreciation of the fair value adjustment, depreciation of the fair value adjustment, you take the fair value, which is 100. You divide this by the remaining useful life. They've told us it's 5. So 100 divided by 5, but now remember that depreciation is time-based. When I take 100 divided by 5, I'll be getting 20, but you see that 20 is per year. Since we acquired this subsidiary S to date, to the date of the financial statements, we saw that we have how many years that have lapsed in between? 3 years. Since we acquired this subsidiary S to date, we wrote there, number of years are supposed to be 3. So 100 divided by 5 times 3. So then this one here will end up giving me how much here somebody took, because you work with total what year? Total depreciation. Work with total depreciation. What we also call accumulated depreciation. So this gives me 60. Remember now depreciation, you only book depreciation here during the year. So depreciation of fair value adjustment. So we have this 60, it has to be a deductible. And that is it. Then kindly come and give me the total net assets at the reporting. The total net assets at reporting. Remember, the 6 months was not S. 6 months is L. For S, we did with you, and we said S is how many years? 3 years. S is 3 years. So then give me the net assets at reporting. You're taking a 1500 plus 500 plus 2070 plus 100 minus 60 minus 20. What are we getting? Angela, she's giving me 4090. Caroline, 4090. Thank you so much, 4090. So let me ask you a question. For the students who tried this question, is there any student who was able to get this working right? Is there any student who was able to get this working right by any chance? Wow, Carol was able to get it right, despite the fact that she did her work in a whole hour, but she was able to get it right. Not many students will be able to get this right. So growth in net assets. Our net assets have grown. Whenever our net assets grow like this, yeah, a good question there. I'll be able to come back there. So whenever we get our growth, assets growing like this, the growth is called post-acquisition profit. What we call post-acquisition profit. So we have in this case here what we call the PAP. So what we call PAP, the growth in net assets, you simply take growth in net assets, you simply take the net assets at reporting minus net assets at what year? At acquisition. So are you able to give me this post-acquisition profit? 4090 minus 2440. So this gives me 1650. What I'm interested in mostly is the share of NCI. Go ahead and give NCI their share. Share of NCI. Share of PAP of NCI. So remember, what is the NCI percentage in this equation? In the entire group for S? Thank you very much for helping Mwalimu answer that question, but I'll answer it. So remember, the group has 80%, right? The group has 80%. So then the NCI, non-controlling interest, will be having 20%. So 20% of 1650, 20% of 1650, which will end up giving us a 350. So this is really, really important. 330. 330. I'll not even be interested in what the parent is getting. I'll be interested in getting the NCI's share of PAP. Now from there, remember, how many subsidiaries do we have? We have 2 subsidiaries. So I'll come and rub this, and then I also do the valuation of the other subsidiary. I'll have to do the valuation of the other subsidiary. So now we are looking at net assets of subsidiary L. Net assets of subsidiary L. Net assets of subsidiary L. Before I go there, remember, here you are not going to change this profit margin. You know, we use profit margin times remaining interest sales. If you look at this Barambada very well, note number 4, they gave us gross profit margin. They have given us the margin already, so we shall not convert. We only do conversions whenever you see examiners giving us profit markup. If it was profit markup, I would have done conversion. But here, this is profit what here? Margin. This is profit margin, and therefore, I will not do any conversions. Are we there? Correct up to there, Bonambada? They have given us profit margin, no conversion. We take it as 25 over 100. We take it as 25 over 100, not 25 over 125, because profit margin has been given. Profit margin has been given. All right. Now we go to L limited. So net assets at acquisition and at reporting. Net assets at acquisition and at reporting. So we start with share capital. Is there anybody who is able to see the share capital of L Limited? Anybody who is able to see the share capital of L Limited? Patapotea, 2,000, Bob. Go to the ordinary share capital over L Limited. You'll be able to see 2,000, Bob. So 2,000. It doesn't have any share premium. Nothing. It doesn't have any share premium. So straight away then, I'll be able to go to retained earnings. So retained earnings, I like this because not many students will be able to see this. Because we have retained earnings at reporting. Retained earnings at reporting, this has been given. Retained earnings at reporting, this is very easy to pick. Retained earnings for L at reporting is 2090. Is that okay? 2090. Is there somebody who is able to see 2090? Retained earnings at reporting. I think I've started losing you guys. Yeah. And then now we have retained earnings at acquisition. This examiner never gave you retained earnings at acquisition. So then what I know, I have, ladies and gentlemen, remember our reporting date here is 31st October 2022. So I have this retained earnings here, 2090, which are the retained earnings, now in this case here, carried forward. But fortunately, these guys have given us profit of L for the year. How much have they given us as profit for L for the year? If you look at the income statement, profit for the year for L, if you look at the income statement, you'll be able to see profit for the year for L. Is there somebody who is able to see 860? For L, profit for the year, look at the income statement, 860. So profit for the whole year is 860. And I want something very easy. I want the retained earnings here at acquisition. Fortunately, I know from acquisition to here, we have 6 months. 6 months. This is profit for a whole year. So come and give me profit for 6 months. Give me profit for 6 months. Give me profit for 6 months. So profit for 6 months, it will be 860 times 6 over 12, which will end up giving me 400 and what year? Which will end up giving me 430. So between here and here, I have 430. And all this money, there is no dividend that has been paid. All this money was retained in this. All this money was put in this retained earnings basket. So if I take this as my X, if I take this as my X, we are saying X plus 430 equals 2090. We are saying X here plus 430 equals 2090. How about X? It will be 2090 minus 430. 2090 minus 430. So is there somebody who is able to give me that figure? 2090 minus 430. So this gives me 16 what here? 1660. So this is the retained earnings at acquisition. Retained earnings at acquisition. So hapa hauna mambo ya fair value adjustment. Wametueleza vizuri sana. Wametueleza vizuri sana. If you look at note number 2, the last sentence. The last sentence, the fair value of L Limited's net assets approximated their carrying values at the date of acquisition. There was no any fair value adjustment. So come and give us what here? Come and give us the totals. No fair value adjustment. Come and give us the totals. No fair value adjustment. Give us the totals. No fair value adjustment. Give us the totals. Total net assets. So please come and add these two. So like this is very easy. I can see this is 3660. This is 4090. That is it. So give me in this case here the growth in net assets. Give me the post-acquisition profit, which will be 4090 minus 3660. 4090 minus 3660. All right. 4090 minus 3660. Is there somebody who is able to give me this difference here? 4090 minus 3660. This will end up giving me 430. So please give me NCI's share. NCI's share of POP. Share of POP. So in this case here, could you kindly tell me, I should take 430 times what percentage of our NCI? Our NCI will take what percentage? Yeah, quite a big confusion, ladies and gentlemen, there. No. Remember, it is management-wise, where we have in this case here, this minority having. Remember the share. Remember, profits is normally appropriated using the shareholding. Remember the 60%, 40%, that's substance over form, that's about management. But that other party has 50% of the company. That other party has 50% of the company. The 60% was just for managerial, of which you'll get another compensation. But when it comes to dividends, dividends will always be based on what shareholding do you have? 50%. 50%. Is that agreeable? Or you want us to talk more about it? Remember the 60%, 40%? Yeah, it's agreeable. So then this one here will give us 200 what here? 215. So revaluation, somebody asked there a very good question. This revaluation, it's debatable. But even if you have to put this revaluation there, Igamba, say it's 10. So it will be 10 at acquisition, 10 at reporting. So in this case, when I get the difference to get PUP, it will cancel out. It will cancel out. So whether you put it here, we put it there, it's neither here nor there. I hope that that answer in this case is able to at least help you, Gamba, there. All right. Now then, ladies and gentlemen, if I'm the one doing this, I will be able to straight away come and give you goodwill. So get goodwill. So go ahead and get goodwill. So how do we get goodwill? It is the purchase considerations less net asset at acquisition. So goodwill. So give me the purchase. So we start with goodwill in the first one called S, purchase consideration. Purchase consideration. We start with the parent company. We start with the parent company. So purchase consideration, we are told in S Limited, purchase consideration in S Limited, purchase consideration in S Limited, purchase consideration in S Limited. What have they told us about purchase consideration in S Limited? Note number one. H Limited acquired an 80% ordinary shareholding in S Limited on 1st November 2019 when the retained earnings stood at that. The acquisition consideration comprised cash of 1830. Remember also NCI, because you only bought 80%, the non-controlling interests guys here also put in something. So the non-controlling interest, ladies and gentlemen, we are told in note number 3. H Limited has a policy of measuring NCI at fair value. The non-controlling interest in S Limited was 970. So in this case here, 1830 plus 970. And then you come and less net assets of S, at acquisition. So are you able to remember our net assets at acquisition? Can somebody give me the net assets of S at acquisition? Are you able to remember that figure? For S, we've already done this. So for S, are we able to remember that figure 24? So 2440. So you subtract there. So you should be able to get goodwill at acquisition. Goodwill at acquisition, 1830 plus 970 minus 2440, which will end up giving me what figure? $970. Great. It's given there. Note number 3. H Limited has a policy of measuring NCI at fair value. The non-controlling interest in S Limited had a fair value of 970. I hope you're together there. So in this case here, goodwill at acquisition, 360. In this case here, we less impairment loss, of which none is given. So in this case here, we have goodwill at reporting. I saw one student, I think it's Mauritia, who did this very well. Was it Mauritia or somebody who did this very well? The 360. She got it. Yeah, 360. Great. So that's goodwill in S. Unfortunately, you guys were only doing goodwill in S alone. You forgot that also L is a subsidiary. Subsidiaries, you must always compute goodwills for all your subsidiaries. You must always compute goodwills for all your subsidiaries. So go ahead and give me goodwill of which one here? Goodwill over, sorry. I don't know whether you guys have been able to finish writing. Have you finished writing? Okay, great. So then go ahead and give us goodwill. Goodwill in L Limited. So goodwill in L Limited. It's a subsidiary. So give me the purchase consideration. So we start with the parent company. So the parent company here, you could see, in this case here, the parent company gave out cash and the shares. There was a share exchange. So you're told here, M Limited, note number 2 I'm reading, M Limited is the main competitor of H Limited. And on 1st May 2022, M Limited and H Limited each acquired 50% of the 200 million ordinary shares of shillings 10 each in L Limited. The consideration paid by H Limited consisted of cash of 15 per share. First of all, we do this cash. So remember, we acquired 50% of the shares. 50% of the shares of L. And we are told that the shares of L were 200. So we got 50% of 200. Those are the shares we took. Gave 15 shillings for each share, times 15. Is there somebody who is able to give me the cash consideration? That's the first thing you ought to have done. Because in this case here, H Limited consisted of a consideration here of H consisted of 15 per share. First of all, give me so this one here gives me 1,500. And then there is share exchange. There is share exchange. Share exchange, I love it so much, I can even do it with my eyes closed. Why? Because I will take the percentage of all the shares, in this case here, acquired, times the exchange ratio. Times the exchange ratio. So do we have exchange ratio? They have told us, and also a 1-for-2 exchange. So times 1/2. And please don't forget, when it comes to valuation, you multiply this by the MPS of the parent company. MPS of the parent company. MPS of the parent company. So 50% of the 200, just like I did there, the shares acquired, times the exchange ratio, which is 1/2, times the MPS of the parent company, of which they have told us there, consist of 15 per share, and also a 1-for-2 share exchange, when the market price of H, which is our parent, was 20. So this is 20 here. This is 20 here. So are you able to give me the final value here? So you take 0.5 times 200 times a half times 20. Please give me a figure to write here. 1,000. It doesn't end there. This is the parent. We still have another buyer called, in this case here, who? The non-controlling interest, because you're using what we call full method. So we want to know the non-controlling interest, in this case here, paid what? Paid what? So what have they told about non-controlling interest? Non-controlling interest, of course, in this case is M, who also has what here? 50%. So M Limited also paid 15 per share for their interest, but did not issue any shares to the owners of L Limited. The ordinary shares of L Limited have one. That's irrelevant. We are told that this NCI, who is M, as well acquired 50% of the 200. And they went ahead, in this case here, to pay 15 per share. It's straightforward. They paid 15 per share. We are told that M Limited also paid 15 per share. Also paid 15 per share. So 50% times 200 times 15. So this one here will give me what figure, ladies and gentlemen, my good students here. All of you are very good. All of you are very good. So in this case here, I'm being given a figure of 1,500. 1,500. 1,500. 1,500. 1,500. And then now you come and less the net assets acquired. Net assets at acquisition. So you less net assets at acquisition. Remember, for L, we also are down the net assets at acquisition and at reporting. Please go and pick the net assets at acquisition for me. Net assets at acquisition for me, which is what year? Which is 3660. 3660 subtract, then you should be able to give us goodwill at acquisition. And of course, there was no any impairment really. So this will be goodwill at acquisition, which is also at what year? At reporting. At reporting. So you take this plus this minus this, 3660. So I'm being given 340. So of course, later on, I'll be telling you that all these will not give you any mark. Whatever you have done here, if I were you, I would have jumped straight away to what I saw Monica writing their pro forma. Because all these will not give you even a single mark. This wastage of time, you can see I've taken my whole hour. But I like doing them this way because at times your examiner will tell you, you must have seen questions in AFR. If it was financial reporting, I'll tell you don't do these workings at all. Financial reporting, if I've ever taught you, and remember, I always get, like the financial reporting I teach, always the #1 student comes from my class. The financial reporting, especially the one, because I always tell them the shortcuts. So even you guys, I mean, if you're able to work with these shortcuts very well, like now this one, although for AFR you'll be told, you must have seen where the examiner tells you, note 1, goodwill. Requirement #2, NCI, they tell you like that. Requirement #3, net assets of the subsidiary. So they can easily single out something. Otherwise, if it were me in this kind of a question where they have not asked me for goodwill, they have not asked me for nothing, I would not have done these workings really. Now from there, then I can start now my consolidations. So we start with consolidated income statement. They're calling it consolidated comprehensive income statement. Consolidated. So there must be, if they call it consolidated, so they want me to give them, oh, not this one. And other, so they basically want me to give them consolidated comprehensive income statement. Comprehensive income statement. Of course, the name of the group is H group. The name of the group is H group. So we start with consolidating the income elements. So we start with the consolidated revenue. So the consolidated revenue, what do I have there? Remember, I have a parent company with the two subsidiaries. Thank you, Taylor, with two subsidiaries. So I'm simply consolidating. Now I'm an expert. So revenue, I will take 8460 plus the one of S Limited, 3880. So many ninjas in this sitting, in this case here, left this L Limited out of the equation. They got zeros, 3200. Then I know, ladies and gentlemen, that the only thing that can affect me in terms of revenue consolidated is any internal sale. Do we have any internal sales? Do we have a situation where they were able to sell to each other this year? How much? What is the internal sale? You can see in note number, there's a note number there. I don't want to be turning this book. There's a note number there talking about, in this case here, internal sale. 400, yes, 400. So minus 400. Nothing else. I don't know why from the few that I marked. I'm sorry, I woke up a bit late. I wanted to wake up at about 3 to mark all your work, but I woke up at about 3:30. I was not able to mark all your work that you guys sent here. But the ones that I marked, I don't know why I was seeing some guys in this case subtracting 80. Sorry. The subsidiary, The subsidiary, yes. The subsidiary, I was forgetting this. I almost got a zero as well. So in this case, ladies and gentlemen, we stayed with L for how many months? We stayed with L for how many months? We stayed with L for how many months? S I know is 3 years, but L has to be time apportioned. So this has to be time apportioned 6/12, you're right. 6/12, you're right. And then you subtract 400. Thank you for that. You subtract 400. So then what figure are we able to get there, ladies and gentlemen? What figure are we able to get? Everybody pick your calculator and give me your final figure. Pick your calculator to give me the final figure. Yeah, 13,540. 13,540. 13,540. All of us. Yeah. So in this case, there are 200, which belongs to the subsidiary L. That 200 is for a whole year, and we stayed with it for 6 months. 13,540. You know, it's not many students will be able to get that 13,540 because of body mass, not many. So apart from this revenue, I'll be able to come and give my examiner the consolidated cost of sales. So cost of sales. So this consolidated cost of sales, I will take the cost of sales of the parent, 4040, plus 2910, plus 1020, and this 1020 is for L, so times 6/12, all right? And then, of course, I must always deduct the intra-sales, the internal sales figure. That 400 must be, in this case here, subtracted. What other adjustment do we bring here? We add UPS. We add UPS, isn't it? So we shall add UPS. We add unrealized profit. Are you able to remember that unrealized profit? Yeah, 20. So we say here plus 20. Plus 20. That is it. Because you see, ladies and gentlemen, the fair value adjustment that we had was not for a property, plant, and equipment staff. The property, plant, and or rather the fair value we had there, we are told is a brand. It's brand value. It's an intangible asset. Intangible asset, we normally impair them. So you can't bring that depreciation for the brand to cost of sales. That will go to administration, just like impairment of goodwill. Impairment of goodwill cannot come to cost of sales. Impairment of goodwill, impairment of any intangible asset will go to administrative expenses. Let's read this note very well. Let's read this note very well. Let's see this fair value adjustment of 100 that we had. What was it really? What was it really? This fair value adjustment that we had, the fair value. So if you read note number one, the last sentence of note number one, the last sentence of note number one, the excess of the fair values over the carrying value was due to unrecognized brand that we were able to depreciate. Of course, its depreciation technically is called impairment. And we got impairment of 20, the cumulative one is 60. If this fair value adjustment was a property, plant, and equipment, then the depreciation of that asset would have come to cost of sales, because we normally use plant and property, plant, and equipment. We use them to boost our sales, to produce manufacturing. Then its depreciation is normally charged to cost of sales. But if you take depreciation of a brand item here, then that means that your financial reporting skills are not very, very good. All right. So then you should be able to come and give us a figure. Somebody is giving us 70, 80, 70, 80. So then you subtract, give us gross profit. Give us gross profit. So gross profit, I'm being given 64, 60, 64, 60, 60, 64, 60. So from there, you simply follow the income statement given. So the income statement given, ladies and gentlemen, the next item, sorry, I'm rushing a little bit fast. You'll allow me to do that because we must finish this, at least the income statement. Yeah. So the next one is called a distribution cost. So we have here distribution cost. So we are consolidating. To consolidate is to add. So we have here 725 plus, we have 200 plus 220 times 6 over 12. This one rarely has any adjustment. Rarely. Distribution cost rarely has any adjustment. Rarely. The only time I saw distribution cost having an adjustment is when they told us that there is a distribution van which had some depreciation. So distribution van that has its depreciation will be brought here. All right, so 1035. So 1035 rarely. All right. After distribution cost, I can see the next one is known as administrative expenses. So we have here administrative expense. I know this one, I have to bring in new expenses. Like impairment of goodwill will come here. Like impairment of these intangible assets like brand names, they will come here. So the administration expenses, ladies and gentlemen, I can see administration, we have 1150 plus, we have 350 plus, we have, ladies and gentlemen, 340, but this 340 has to be time apportioned. And then remember, we had, ladies and gentlemen, in this case here, we had what here? We had a brand name, which was amortized, which was impaired. Is there somebody who is able to tell me I should come and add what here? I should come and add what figure, somebody here? Abracadabra. I should come and add what figure here, somebody? 20. Igamba, no. You know, cumulative normally goes to the balance sheet, isn't it? Income statement is for a single year. Income statement is for a single year. So 20 here. So I like this class so much because you guys are participating, which is really making our work very easy. So how much do we have there, ladies and gentlemen? 1690. So write 1690. All right. So after administrative expenses, I can see we have profit from operations. You simply follow what they're telling you. So come and give us here profit from operations. So profit from operations, are you able to subtract this? Please give me this profit from operations. 6460 minus 1035 minus 1690. What do we have here? Thanks, Edna. So profit from 3735. Thank you so much. 3735. So you move on to the next thing, ladies and gentlemen. We have investment income. Investment income. There is only one figure there for the parent, 600. So you can just write here 600 plus 0 times 6 over 12 is the same as 600, right? 600. So of course, later on, should they tell us that this is investment income derived from its subsidiaries, then we shall be able to say, hey, this fig, we shall be able to eliminate it. But for now, let's book it in. It's an income, it's positive. After that, ladies and gentlemen, I can see we have finance cost. Like now, this one rarely does it have any adjustment. It's about consolidating. So finance cost, we have 450. We have 450 plus 175 plus 320. So this has to be time apportioned. Nowhere have they told us about any internal lending, which may lead to, in this case here, internal finance costs. That is fake, that should be eliminated. What is the total for finance cost? I'm being given a figure of 785. 785. So this is a deductible. Then you should be able to give me profit before tax. Profit before tax. So 3735 plus 600 minus 785. What figure do we have there, ladies and gentlemen? And the rest, I never saw your work. I never saw your work this time around, Ressa. What happened? You always do your homeworks. What happened? So 3550. All right. Then, of course, taxation rarely. Taxation is free mark. So we have their tax expense. Tax expense. So tax expense, what do we have here as our tax expense, ladies and gentlemen? I can see 680. 680 plus 80 plus 440 times 6 over 12 times 6 over 12. What do we have there, ladies and gentlemen, as our taxation? I'm confused you, Ressa. But now I shall never confuse you. So come and give us profit for the year. Profit for the year. Profit for the year. So profit for the year, you simply subtract. $25.70, right? So we have $25.70. And then I can see another free mark that this examiner has given me. Other comprehensive incomes. Other comprehensive incomes. Very easy. OCI. The concept of revaluation gains. Revaluation gains. Very easy. Free marks. Always, whenever you see this, you can even start with it. So revaluation gains, are you able to see their gain on property revalued? Gain on property revalued. Are you able to see that? Revaluation surplus. So it is basically for the parent. You can just write here 70 plus 0 times 6 over 12, which is 70. And then now you are able to give me the total comprehensive incomes. 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 What figure are you able to see there as our total comprehensive incomes? Take in this case here the other, the profit for the year plus OCI, other incomes. 26. 640. So don't continue with this statement any further. That marks the end. Like that. You see, you may not have been correct in most of these things. You may not have been very correct in most of these other things, but trust you me, this exam, and I'll give you the marking schemes. It'll come and pick like any five that are correct at two. You get 10 over 10, 10 over 10. I'm telling you, AFR is more about what here. It's more about confidence. Are you courageous enough? If you're courageous enough, you'll always pass this paper. And I will endeavor to raise your courage levels by giving you lots of work. Remember, I'm your coach. As your coach, I must ensure that you pass this thing round one. Is it by force and by fire? I don't know. But we have to really, really put in efforts there. Yeah. Any five, you'll be surprised. Any five, in this case here, you have all the marks there. And then you'll go out there jumping up and down. Hey, I've gotten a pass in AFR. I mean, I'm right. Yeah, but not knowing that it is about the correct entries that you pass. It's not about excellence. It's not about perfection. It's not about perfection. It's not about perfection. AFR, if you go for perfectionism, you will repeat this thing 10 times, like I told you yesterday. Somebody has been sent to me. Yeah, she has failed 10 times. This thing does not want any perfection. It just wants students who are courageous and students who are able to take what here instructions. When your coach tells you, I mean, do this and this, you have to do what your coach tells you to do. You have to do what your coach tells you to do. H group, consolidated statement of financial position. I'll be able to finish this in 5 minutes. In 5 minutes. H group, consolidated statement of financial position as at. I saw Monica writing as at like this. No. This is for Mwalimu. I'm the only person who is required to write like that. At has to be written professionally. All right? Has to be written professionally as at this date. And then you start with your assets. So start with non-current assets. Non-current assets. So non-current assets, what do I have here? I have, ladies and gentlemen, property, plant, and equipment. So property, plant, and equipment. So property, plant, and equipment, ladies and gentlemen, that I have here, I have 4,600. 4,600 plus 4,940, 4,940 plus 3,820. Yeah. So here we don't do time apportionment. We don't do time apportionment. We don't do time apportionment. So could you kindly give me that total? What do we have there? The fair value adjustment cannot count to this because it's not a PPE item. That's intangible asset. That's intangible asset. So we have here 13,360. 13,360. So we have intangible assets. Brand name. 100 minus 60. Because balance sheet, I'll work with total depreciation. Total depreciation. So up to here, are we following? That's a free mark, intangible asset. I know most of you mixed up things. Yeah. You took that 100 in the PPE minus 60. Yeah. And I forgive you because you're still learning, you know. But the moment you become, in this case, a seasoned accountant, you can't mix what you can touch and what you can't even see. You can't mix tangible and intangible assets. They will always be separated. They fall under different accounting standards. Goodwill. So do you remember the goodwills? You guys have done these figures. Let's add them. Goodwills. Goodwills. Do you remember them? 360 plus 340. Yeah. I like some students who are writing them separate, like for this, still the same. We should only have one line of goodwill. We should only have one line for goodwill. But even if we have to spread them, still good enough, fair enough. Fair enough. So goodwill, 360 plus 340. 700. Then we have there, if you look at this thing, we have what they're calling equity investments. Equity investments. Are you able to see equity investment? Free marks. Free mark. Equity investments. So equity investments, what do we have here? 4,000. Simply bring it here. So please give me the total and current assets. Yeah, why have I subtracted 60? Because remember we got 60 as the total impairment. Yeah, like total depreciation, if you remember, Angela. So I want to get net book value. Remember, we book assets at net book value, where you take the cost minus accumulated depreciation. I hope, Angela, you're able to remember that. 18,100. 18,100. Right. Then now we come and bring current assets. We bring current assets. Current assets. Current assets. So current assets, what do we have here? Under current assets, we have inventory. So we have inventory. So inventory, ladies and gentlemen, what do we have here in inventory? We have 2250 plus 2450 plus 1875. So what am I going to bring under inventory as my adjustments, inventory adjustments? If there are any goods in transit and the UPS. And the UPS. Like in this case, there are no goods in transit, so we only have UPS. So on the UPS, you guys are help me calculate this. It was minus 20. Minus 20. Can I ask a question? I saw you guys using a figure of 810. All the students who turned in their work, I saw them using a figure of 810 throughout. Where were you getting that figure from? I tried looking at it. Where were you getting that figure of 80 from? Because I saw you adjusting your payables, receivables, and even inventory with it. Is there somebody who is able to tell me in this case here where they were getting that figure from? As they give me. So the inventory figure that you guys should be working with, as you guys tell me where you got the data from. So is there somebody who has this net figure here? Inventory. 65.55, right? 65.55. Thank you so much. So after inventory, ladies and gentlemen, I can see there we have receivables. So receivables, we have 1980. After 1980, we have 1710. After 1710, we have 2700. Yeah. In this question, hakuna kitu kama internal receivable. Yeah, good questions there. Hatuna kitu kama internal receivable hapa. Again, I saw you guys saying minus 80. Hatuna internal receivables hapa, si ni kweli? So please give me the final figure here before I answer Taylor. 6390. So you have 6390. Remember, you can't say, and I've explained this even in your LMS quite a lot. When, for example, Taylor, you pay master's fees for your wife, will you count that as an investment, really? Will you keep on reminding her that you know what I took you out there and to do masters and you're shining because you did masters through? No. That's investment in yourself. So you can never, in this case here, account for investment in subsidiaries. The only thing you can be proud of is the goodwill. So whenever you see investment in S, you replace that with goodwill. You replace that with goodwill. You can't talk of investments within the group. Investments within the group, those are fake. It's a fake. So then after receivables, ladies and gentlemen, what else do we have there? After receivables, we have in this case here cash. This is very easy. Cash. Free marks because there's no cash in transit. Free marks because there's no cash in transit. 870 plus 600 plus, we have 705. So are you able to give me this answer? So I'm being given a figure of 2175. 2175. So is there somebody who is able to give me the total assets? Please give me the total assets. Give me the total assets. So you take the non-current assets plus now the 3. Plus the 3. So total assets, what do we have here? 33,320. 33,320. Like that. Thank you very much. So come and rub this. In my case, I'll rub this because now I'll go to equity. Now I'll go to equity. So that figure should be balancing with my total equity and liability. So we look at equity and liabilities. So we start with equity. Equity is start with share capital. So we take the figure of the parent only. The figure of the parent only. So share capital for the parent, I can see 3,000. But remember, this parent gave out some shares, if you remember. It gave out some shares. And it was 50%. I hope you are able to remember that working. Times 200 shares, times was it a half, times 10. I saw one student who got this right. I mean, I felt very, very happy. There's one student who got this figure right. Share capital. Whenever it issues shares out, we must always, in this case here, do what here? We must always bring in those shares issued. And remember here, you guys remember from the working we used 20. Do you remember we used 20 and not 10? Why am I using 10? It's because 10 is the par value per share. The other 10 will come here under share will come under share premium. The other 10 will come under share premium. Oh, Carol got it right, right? Yeah, this is a lady called Carol in tough. Yeah, so please don't use 20 here. No. When you come to the share premium already we have the parent having share premium, which is 2,000. Plus now this 50% times 200. Remember the share exchange was a half times 10 for us to account for 20 in total. So is there somebody who is able to give me these figures pretty fast? Wait, now 35, now they're not talking. Now they are not talking. 3,500. And then we have share premium. Share premium. Now they're not talking at all. Now they're not talking at all. Now they're not talking at all. Now they are not talking at all. Share premium is 200 what? 2,500, right? 2,500. Then we have a revaluation surplus there. Revaluation surplus, no adjustment. We take it the way it is. Revaluation surplus. Free mark, 480. Then we have, ladies and gentlemen, in this case here, retained earnings. Group retained earnings is one of those complicated workings. So in this case here, group retained earnings, I can even draw an emoji for him. The one in this case that is really, really sad. A sad emoji, I'll not do it. Under equity, I have in this case here NCI. This, if I get time, I'll do it. I can smile a little bit. If I get time, I'll do it. But again, if I'm the one doing this exam, I want to do it. I want to do it. Right? Yeah. I'm giving you things, ladies and gentlemen, that I've used. Remember, during my time, I was the best in AFR. During my time, those old days in CASNEP. I was doing ACC, a paper called P2. Now they have changed to SBR. I was number 19 globally. Number 19 globally. And I'm telling you techniques that work. Techniques that work. Yeah. But again, the other technique that has always worked out for me immensely is hard work. I mean, I'm really hardworking. I'm really, really hardworking. And at times I can call myself a workaholic. I love my work. I love my work. And I like studying a lot. I like studying a lot. Yeah. I like studying a lot. I like studying a lot. All the way from university when I was doing civil engineering. You know, I'm a civil engineer by profession. Now I'm doing accounting like crazy, right? Right? I'm really, really hardworking. I would want to continue doing like this for another 4 years. Once I hit 50, then now I should be able to change in our course and do other things. Yeah. Yeah. So anything to do with structural engineering. For those of you who will be putting up good high-rises houses, I will be a structural engineer. Yeah. structural engineer, you don't call me when, for example, you are doing a 3-bedroom house, like, no, no, no. You call me when you're doing like a high rise. Yeah. And you would want, in this case, a very strong beams, very strong columns. Whenever you're constructing, ladies and gentlemen, don't take shortcuts. Ensure that you have, in this case here, first of all, a land surveyor. Land surveyor, they should be able to come and show you the beacons. Very, very important where they fence your land very nicely. Get, in this case here, an architect who should be able to draw for you. If you're looking at loan financing, you need, in this case here, a QS, a quantity surveyor, right? You will need, in this case here, a structural engineer. If, for example, your house has a lift, more than 4 floors, you need a lift. Then you need a mechanical engineer. Yeah, don't work with just shortcuts where you are bringing in just like a contractor alone. So this contractor, in this case, is just doing, you don't even have a clerk of works. It becomes an international disaster. One of the fine days, again, we see you on the televisions that, I mean, this guy did a house that has killed people, it collapsed. So that's another thing I'll be talking about later on. But we shall overcome. We shall overcome. We shall overcome. All right. So those I'll be able to do them if I get time. So now after that, of course, we shall be able to get the other free marks. I will be able to run very fast and get these other free marks. So like now we have what we call non-current liabilities. So non-current liabilities. So non-current liabilities. So non-current liabilities, I can see there, long-term borrowings, free marks. Long-term borrowings, free marks. Long-term borrowings, free marks. So long-term borrowings, we have 4,400 plus 2,500 plus 2,500, which gives us what figure? Yeah, we shall overcome. Yeah, great. So 6,900, isn't it? 6,900, no adjustment. Now from there, ladies and gentlemen, after long-term borrowings, we have in this case here deferred tax, no adjustment. Deferred tax, no adjustment. So we have deferred tax 1,240 plus 920 plus 920 plus 1,750, which gave you guys what figures we finish? Yeah, 3910, right? 3910. Then we have here current liabilities. So current liabilities. So current liabilities. So we have here payables. So we have payables. So payables, we have 2,240 payables. As I finish this, I can see we're now getting late to prepare. Myself, I have to prepare very fast. 1,570 plus 2,300. So these payables nakuja ngapi, ladies and gentlemen? The payable 6,110, right? 6,110. And then we have, ladies and gentlemen, current tax. So current tax, no adjustments, 1,250 plus 640 plus 640 plus 960 plus 960. So we have 1,250 plus 640 plus 960, which will end up giving us what figure, ladies and gentlemen? 2,850, like that, 2,850. So you will see there is nobody who will ever pen. You will get all the marks 10/10 even without these two things that you learn. Don't even bother about them. Don't bother about them. Although for NCI, I would want you to try later on. Doing a working for NCI is not very, very hard. So that is it. And of course, for your take for the day, you know, ladies and gentlemen, having done many, many qualifications here, the qualification that I'm so proud of is this. This is something that can really, really take you to places. Now, unlike us, during your time, if you would want to flourish with this CPA, yeah, so you must be technically sound. You must know these standards very well. Please endeavor to know your standards here. I mean, like yesterday, was it yesterday? No, on Friday, we announced, you know, right now, RCM is really growing at a very, very fast rate. So now we wanted a finance manager. And then in this case here, I was able to put a salary there. So of course, we were paying our finance manager 180,000. And then of course, we have other benefits here because now RCM is becoming big and big. So then I got very good. We are in this RCM family. I hope you guys are in the RCM family group. RCM family. So I advertised there and said we must recruit our alumni, our student, either who has a CPA or a degree or both. So now we got 40-something applicants. These guys now came to the office here. I mean, you try to ask somebody about it. It's only one lady who got this job here. And she got the job because she was very forthright, willing to learn, etc., etc., like that. And then I realized a big problem that most of you, ladies and gentlemen, are not investing in public speaking. You get somebody who has a very, very good CV when they're walking into the room, you can see they're looking, in this case here, down. I mean, unakuja tu kwa interview kwa umechoka tu, unaona. So public speaking is key. And then, of course, apart from technical skills, you must be very good in Excel. So, for example, we gave these guys here a trial balance and asked them to use some ifs, to give us a P&L, to give us a balance sheet. I mean, it's only this lady called Rosso who was able to do it. The other guys, very good CVs even with masters, nothing. So I'll be able to coin something, especially over December, when you guys will have done exams. We need to talk about this. This is very serious. You cannot be at this era, ladies and gentlemen, us, luckily, we don't have to be very, very good because as our time now is over. But you guys, during your time, you have to be very articulate. You must be a great public speaker. It can't be like you, for example, like you're an accountant, will be addressing multitudes here, many people, all right? Like even 20,000, you're reading a report, Safaricom's report, annual report as an accountant, as an auditor. And then here you are mixing R and L. I'm not the bridegroom. I'm the bridegroom's brother. It cannot work. That one is international disaster. Thank you so much, ladies and gentlemen. As much as I always keep on telling you, my aim is to ensure that you pass this thing first round. Thank you so much. Be blessed. Bye.